This is how high-income professionals invest in large apartment buildings without becoming landlords. In this video, I'm going to take you inside a real 240-unit multifamily deal and show you the numbers, the business plan, the projected returns, and how passive investors actually make money. Because once you understand how these deals work, you'll never look at real estate investing the same way again. And by the end of this video, you're going to understand how everyday busy professionals, doctors, engineers, business owners are participating in deals like this as passive investors without managing a single tenant, without getting a real estate license, and without putting their entire net worth on the line. Be sure to like this video and hit subscribe so you don't miss what we have coming next. Now let's get into it. First, let me tell you who this is for. This is for you if you're a busy professional with investable capital, typically $50,000 to $200,000, who wants to put that money to work in real estate but doesn't have the time, expertise, or desire to buy and manage property yourself. You've heard about syndications. Maybe someone sent you a deal and you want to understand what you're actually looking at before you commit a single dollar. Now, there's two myths I hear when talking to high earners who are thinking about investing for the first time. Myth number one, you need to be ultra wealthy to invest in large apartment deals. And no, you certainly do not. Most syndications accept minimum investments of $25,000 to $50,000 or so from accredited investors. That means a household income earning over $200,000 individually or $300,000 as a married couple, or a net worth exceeding $1 million, including your primary residence. Myth number two, bigger deals mean bigger risk. Actually, the opposite is actually true. A 240-unit apartment community has something a 4-unit rental never has: scale. If 3 units go vacant in a 240-unit building, you still have 237 paying rent. In a 4-unit property, that's a 75% vacancy rate. Scale is one of the most underappreciated risk reduction tools in real estate. Now, here's the core reframe. Most high-income professionals spend their careers building active income. They're very good at earning money, but they've never been taught how to make that money actually work as hard as they do. A well-structured 240-unit apartment investment is one of the most efficient vehicles for doing exactly that. Now, let me show you what it actually looks like. Let's walk through a realistic 240-unit value-add apartment deal in 2026. I'll give you real numbers, not a pitch deck, not a fantasy, just a grounded, honest example based on current market data. The property. 240 units, Class B apartment community, built in the late 1990s, located in a secondary Midwest market with stable employment, modest population growth, and limited new supply coming online. The property is 93% occupied at acquisition, which is solid, but the rents are running $150 to $200 below market because the current owner hasn't renovated the units in over a decade. That gap between the current rents and the market rents is the opportunity. That's the value add thesis, the purchase price. The property is acquired at $36 million. That's $150,000 per unit, which in 2026 is a meaningful discount to replacement costs in most secondary markets, where building a new construction runs $200,000 to $250,000 per unit or more. And according to CBRE's Q1 2026 multifamily report, the national multifamily vacancy rate declined to 4.8%, below a historic 5%. And net absorption outpaced new construction completions for the first time in 3 quarters. The supply picture is improving. The timing for a well-priced acquisition is favorable. The capital structure. Here's how the $36 million purchase gets funded. So, senior debt, a Fannie Mae or Freddie Mac agency loan. It covers roughly 65% of the purchase price. That's $23.4 million. And in 2026, the multifamily loan purchase caps for Fannie Mae or Freddie Mac are at 88% billion each, a combined $176 billion, which means agency financing remains widely available and competitively priced. And agency loans on stabilized multifamily are pricing between 5.5 and 6.5% fixed rates. The remaining 35% or $12.6 million is the equity. The general partner or sponsor contributes about 5 to 10% of that equity, the real skin in the game. The limited partners, the passive investors, fund the remaining 90 to 95%. On top of the purchase price, the sponsor raises an additional $3.6 million in capital reserves for renovations, closing costs, and the working capital. Total equity raise, approximately $16 million. The business plan. This is the value add part of the deal. The strategy is simple. Renovate units as they turn over. New countertops, appliances, fresh flooring, modern fixtures. The budget, $8,000 to $12,000 per unit. In exchange for those improvements, rents raise about $125 to $175 per month per unit. That's a renovation yield, meaning the annual return on the renovation spent of roughly 15 to 20%. That is a very strong return on the capital. And over a 5-year hold, the sponsor targets renovating approximately 180 of the 240 units. As rents rise across the renovated units, the NOI, or the net operating income, climbs meaningfully. At acquisition, the NOI might be $2.16 million or so a year. And here's how we got there. 240 units at an average of 1,050 generates $3.02 million in gross potential rent. Subtract 8% vacancy allowance, that's $242,000, and operating expenses running at approximately 45% of effective gross income. You arrive at an NOI of approximately $2.16 million. At a $36 million purchase price, that's going in a cap rate of 6%. And according to 2026 outlooks, value add going in cap rates are averaging 5.23% in primary markets, so 6% in a secondary Midwest is well within that range. And after 5 years of renovations and rent increases, the projected stabilized NOI rises to approximately $3.1 million annually at an exit cap rate of 5.75%, which is flat to slightly compressed from the going-in rate. And according to 2026 buyer underwriting assumptions, the projected sale price is approximately $53.9 million. The investor returns. Let's look at what this means for a passive investor who puts in $100,000. The deal offers an 8% preferred return, cumulative, paid quarterly from cash flow. In years 1 and 2, while the renovations are underway and some units are temporarily offline, cash-on-cash distributions may be 4 to 5%. By year 3 and beyond, as stabilized rents start to kick in, distributions climb to 7 to 8% annually. And at the exit in year 5, here's the waterfall. First, all investors receive their original capital back. Then the cumulative preferred return is paid in full. The profits above that are split 80-20. 80 going to limited partners, 20 going to the general partners. The standard structure in 2026 syndications. And on $100,000 investment with an equity multiple of 1.75 times over 5 years, the investor receives a total of $175,000 total, including the distributions, their share of the sale proceeds. That's $75,000 on profit using $100,000 investment. A projected IRR of 14 to 16%. Completely passive, no property management, no tenant calls, no leasing decisions. Now, let me address the concerns I know you're carrying. What if the renovation costs run over budget? And this is the most common execution risk in value add deals, and it's legitimate. The best sponsors address it in 2 ways. First, they get real contractor bids before closing, not rule of thumb estimates. Second, they build a 10 to 15% contingency reserve into that capital raise specifically to absorb cost overruns. A well-structured deal accounts for this before the first dollar is even deployed. When you're evaluating a sponsor, always ask, what is your contingency budget and have you completed value add projects of this scale before? Question 2, what if rent growth doesn't materialize the way the projections assume? This is exactly why the underwriting assumptions matter more than the headline return. And according to CBRE's 2026 data, it shows that buyers are underwriting rent growth at 3 to 3.5% over a 5-year hold, not the 5 to 6% that you saw previously. A deal underwritten at 3% rent growth with conservative vacancy assumptions still works if the market delivers only 1 to 2% growth. That's your margin of safety. Always ask a sponsor, what does this deal look like at half the projected rent growth? If the answer is it still works, that's a deal worth considering. What about the debt? What if the interest rates stay high? And in 2026, agency financing through Fannie Mae or Freddie Mac remains the most reliable and competitively priced debt available for stabilized multifamily. The $176 billion combined purchase cap ensures liquidity in the market. For a value add deal using bridge financing during renovations, the risk is the bridge loan maturity. The best operators underwrite conservative timelines, assuming they need 18 to 24 months to stabilize before refinancing into permanent debt. And if the bridge loan is sized appropriately and the renovation timeline is realistic, the refinancing risk is manageable. Now, let me paint you a picture of what consistent participation in deals like this looks like over time. Imagine it's 7 years from now. You've purchased or participated in 3 syndication deals, each one 150 to 300 unit value add apartment communities. Each one has exited or is generating stable quarterly distributions. Your total investment across these 3 deals was $250,000. Your total return, including distributions and sales proceeds, is $430,000. That's $180,000 in profit, completely passive, generated while you continued your career, your family life, your practice. The money worked. You didn't have to. And here's the compounding insight. Each deal you participate in teaches you way more about what great underwriting looks like, what great operators look like, and what markets are positioned to outperform. Your judgment begins to sharpen. Your network deepens. Your portfolio grows. This is not a one-time transaction. It's a long-term wealth building system. If this walkthrough resonated with you and you're beginning to see how a deal like this could fit into your financial life as a busy professional, I want to make sure that you have everything you need to take the next step with real clarity and real confidence. Go to cardiarei.com, and when you get there, you'll be able to download 2 free ebooks, one about taxes, one about syndications. They're written specifically for high income or higher income professionals who are serious about passive real estate investing and want a clear, practical starting point without the overwhelming information and without the sales pressure. You also get an immediate access to a free 9-part passive investment masterclass. Inside that training, I'll walk you through the exact framework that many investors, including myself, use to build slow, boring, long-term passive income through real estate. From evaluating your first deal, to vetting sponsors, to understanding deal structures, tax strategy, and how to build a portfolio that fits your specific financial situation and goals. Everything you just learned in this video, the capital structure, the business plan, the waterfall, the return metrics, is one piece of a much bigger blueprint. The 9-part passive investing masterclass really is where that full picture begins to come together, step by step, in a format you can actually act on, and it's completely free. This training was built specifically really for busy professionals, people who want that conservative long-term passive income without quitting their jobs, sacrificing family time, managing tenants, or becoming a landlord. So if you're serious about building that, you can head over again to cardiarei.com. Okay. And in the next video, we're going to cover the difference between equity multiples and IRR and cash on cash. You don't want to miss that. I'll see you in the next video.